Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Monday, October 3rd, 5:42 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market still in a correction across all three time frames, and as far as leaders are concerned, this means that all five of the major indexes are trending below their short-term 21-day exponential moving average, below their medium-term 50-day moving average, below their long-term 200-day moving average. We focus on what the indexes are doing because that's a key to the overall market, and 75% of all stocks will follow what's going on with the overall market. As far as leadership goes, we've had some outperformance in our G6. I'll talk about that for a minute, and some decent action today on some leading stocks. In fact, some decent action across the board as far as what just happened today. Big bounce to start Q4. I guess you could say Green Day has a song, Wake Me Up When September Ends. Maybe Green Day ordered up this Green Day since September ended, and we now kicked off Q4. You can see the big green numbers, G6. This is our 6 ETF composite of six major growth ETFs. Helps us keep our finger on the pulse of what's going on in growth land. G6 up 2.6%. Would have been up a lot more, but one of the components, ARK-K, has Tesla as its largest holding, and Tesla was down 8.5% today. So G6, which showed some outperformance last week, I talked about that late last week, and following through today, which is good news for the overall market, although it is just day one as far as the big indexes are concerned. S&P 500 up 2.7%, NASDAQ 100 up 2.35%, Dow up 2.7%, but it's not day one for mid caps and small caps. They did not undercut late last week, so technically it's day 4, day 5. We'll take a look at the charts in a minute. So with the volume, I don't see mid cap and Russell volume separated out. But you could make an argument that today was a follow-through day on mid-caps and small-cap indexes. Mid-caps being up 2.9%, Russell 2000 up 2.65%, Global Diversified 60/40 stock and bond up 1.8%. GROTECTION took a couple steps back in. Let's say we dipped a foot back in the market today. Up 0.10%, very typical for us to lag on this first day. But then again, we didn't miss the 5% sell-off since last time we went to cash. Still have a 1,500 basis point or 15% lead over the market year to date. We'll get to the tail of the tape and some tidbits from rebuilding the 21 over 21 in a little bit. But first, let's get to an explanation of what we do here at Revere and why we do it. And it all comes down to this chart right here. This chart right here, fresh with a disclaimer that says reflects intraday high to low during each time period, because some clown on Twitter said I was trying to fearmonger by showing what the actual returns were by not saying what the exact dates were. But I mean, you deal with all kind of people on Twitter. But anyway, here's the last 13 bear markets reflective of the intraday high to low during each time period. And we're right here. This is updated. The high to low from January to last Friday, September 30th, 2022, was a 25.6% drawdown. We need 34.4% to get back to even to where we are at the beginning of the year. Hopefully, we're at the bottom and we don't turn into one of these severe bear markets. I classify severe as more than 30% down. There have been 6 of them since 1970, and they lose on average 44.5%. You need an 80% gain to get back to even on that. We stress this because so many people are entering retirement right now, including our clients, and we are experts at protecting the downside. GROTECTION is our flagship portfolio. We grow accounts when the market is trending higher. We protect accounts when the market is risky or trending lower. If you look at this chart here, I can give you a simple example. Here's a perfect market right here, last October, November. Basically, this means the moving averages are trending above their uptrending 21-day short-term moving average, their medium-term 50-day moving average, and their long-term 200-day moving average. We're as long as we can be comfortably in the market when the market is in that state, because historically, markets just don't crash from all-time highs. They start making lower highs and then they roll over, and then you can really see risk pick up if you break below the 200-day moving average, which is what happened in mid-January of this year. This is when we first went to cash, January 24th for the first time. We poked our heads around the 200-day moving average a couple times, and then the 200-day moving average peaked and rolled over on April 21st. We avoided this whole leg down, participated in this move back up as we got a short-term signal to get back in above the 21-day moving average, ran into the declining 200-day moving average, had our latest sell-off leg, which undercut the lows from mid-June, but reclaimed them today, and this is critical when I talk about why we added exposure today. Bumped into the declining 8-day moving average for the first time since 9/21, and a little tick up in the 8 EMA. This actually flattened today. If you look closely, it had a little bit of a tick up. So that's good news. We want to see if we can get above today's highs tomorrow and make a run into the 21-day exponential moving average, and then we'll see what happens when we get there. So that's what's going on with the 50-day, with the S&P 500 chart. That's how we manage portfolios. And if you're interested in this trend following approach, reach out to me, don@revereasset.com, or email dan@revereasset.com, or call 855-REAL-WEALTH. That's 855-732-5932. And again, we want to welcome all the new clients that came over this year, but in particularly over this past quarter, from pie chart advisors that did not protect their downside. Not even just pie chart advisors. A lot of them buy 50, 75, 100 individual stocks and think you're diversified, but when all of those stocks go down along with the indexes and they don't sell, you've got a problem. They've got a problem. They won't admit it. But it's up to you to take action if that's what actually happens. And a lot of people took action this last quarter, and we're very happy to have them as new clients at Revere. So reach out to us. It's not about a fear of missing out to the upside. It's about fear of going lower. Fogel, we'll call it. Fear of going lower. That's what you should be concerned about. Not Jared Fogle from Subway. Not that guy. Just as bad as him, but Fogel, fear of going lower. So that's what you need to be concerned about. But hey, we dipped some toes in the water today, and we'll discuss that in a minute when we finish with the indexes. So NASDAQ 100, same situation, undercut last week, right into the 8 EMA today as we reclaimed those shakeout lows. When you have a failed breakdown and you go back into the prior area where you were basing, that's a signal that a failed breakdown may put in a bottom, and it's a decent risk reward to see if the market can hold that bottom and go higher. Here's NASDAQ 100. Let's go to the Dow Jones Industrial Average, which did pretty much the same thing. Undercut on Friday, actually undercut earlier in the week. This was the weakest of the indexes from a price standpoint, but not from a relative strength standpoint, as the S&P holds up better during this harsh last 3 weeks down that we saw. Closed right on the EMA today, the 8 EMA. Now let's get to mid caps. Notice that they did not undercut this area last week. Intraday we did, but not on late in the week Friday. So that technically makes this, if this is day one up, this makes this day 5 for mid caps. Day 1 would be the first positive close with the undercut. That would be the 27th, 28th, 29th, 30th, 10-3. This is day 5, arguably. Now, you can't go by the volume of the ETF. That doesn't reflect the volume of the index. And end of month had volumes are spiked anyway. So I'm not saying this is a follow through day, but I am saying that it's not day 1 off the low, so you don't have to be as concerned about short covering as you would be on day 1. That's one of the reasons why the O'Neill methodology waits till day 4 for a follow through day, and today is only day 1 on those big cap indexes, but it's day 5 on mid caps. Let's go to small caps. Same situation, we undercut last week. Did we even undercut 162.78, 163.28? We did not even undercut in June, so more relative strength there. So we undercut reclaimed on the mid caps, did not undercut on the small caps, closed above the 8 EMA today for the first time. Look at the relative strength all of last week and including today on this. So, but we did stop going down, so that makes this day 5 also. And again, I don't know if you're going to call a small cap follow through day, but that and the fact that the G6 has shown some relative strength, as I talked about in last week's videos, it's a good sign. It's more than a single good sign than if it would be day 1 just on the indexes. And volume on the indexes relative to Friday was up today. Actually, it ended up down today. It was higher all day, but now we're showing lower at the end of the day. I've got to confirm that. That's kind of strange with on the NASDAQ and on the NYSE. And I think that that's because of the big volume that came in at the end of the day on Friday because of the month-end trading that settled at the close. So anyway, it's not day 1 on small and mid caps. We did have some relative strength in the G6 last week and today, at least even today. And if you factored out Tesla, the G6 FAR would have outperformed today. And we had some good action in individual stocks, enough for us to take a couple of entries, which I'll talk about in a minute as I go through the tail of the tape. So still the same headwinds that we've been dealing with. Technical, I changed from a yellow font to a green font as this attempting hookup got a higher high today on all 5 of the indexes. We didn't cross back below the moving average, which is a plus, even though after the Wednesday positive move was followed by 2 down days, Thursday and Friday. The stochastic is still trending up, which is definitely good. Now let's look at the stochastic for the rest of the indexes. Same thing, a higher high on MDY. Let's go to QQQ, a higher high. Let's go to the Dow, a higher high, and let's go to the S&P 500, a higher high. So that's why I changed the font from yellow to green on those, as it's another sign in, it's another check mark in the positive column, let's call it that. We're still on the bear case, but we're looking for the bull case to initiate a rally and reclaim the 21-day exponential moving average, which also something changed there today. We had been trending between 4.5% and 6.5% below the 21. This is our highest close relative to the 21, being 3.4% down. Our highest close to the 20 relative to the 21 in the last 2 weeks. So basically what that means is we stock going down as fast as the 21-day exponential moving average is going down. So another check mark in the positive column. So how about some news? UK scrapped their tax cuts, which caused their bond semi-crash last week. So the market took that as a good sign. The oil market popped big time on OPEC saying they're going to cut some production. Nice cartel you got there. And then at 10 o'clock, take a look at this chart on a 5-minute chart on the S&P 500. Actually, take a look at a 1-minute chart. I can't fit the whole 1 minute. So can I fit the whole 1 minute chart here? Yes, I can if I do this. No, I can't, and now I'm just wasting time. Hold on. Boy, I really want to show you this apparently, don't I? Okay, it's not going to work on the 1 minute, but take my word for it. So here's what happened. The gap up today, we sold off early, and then we formed a cup and handle in the first 30 minutes, and then a big pop. There was actually a gap up right at 10 o'clock because the ISM employment number came out, and it came out weak. Weak is good. Anything that keeps the Fed from pumping the brakes and increasing interest rates, the market sees as a positive. So we broke out at 10 o'clock, had a nice move up, formed another base with a high handle, broke out again, ran up to 36.98, and then faded into the close. This is a positive day. 2 breakouts of 2 cups and handles intraday. Reasonable pullback into the close that stayed above the second breakout area, which was around 3674-ish. We closed a little bit above that, so we want to keep an eye, and we're slightly higher after hours, I believe. So we do want to keep an eye on that. But good news again, more pluses, more checks in the plus column, so that's good stuff. Sectors, bonds were up today, which means interest rates came down. The only things that I saw on my watch list that were weak was the dollar. That's also good for stocks, and these managed futures indexes, or ETFs, which are trend following, longer term trend following, so they were down today with the market being up. Let's take a look at the VIX also. The VIX on a daily chart pulled back, held this 30 area, first closed below the 80 MA in 2 weeks, very similar to the first time we got back to the 80 MA. On the indexes, still above all three of the moving averages, still above this 26 level, sitting on the 30 level. We're keeping an eye on the VIX too. A lower VIX confirms the move up in the indexes. Here you can see the VIX closed at 30.10, down 4.8%. The put call 0.96, that's on the low side. Fear and greed up 8 to 23, so well off of extreme fear, closer to just plain old fear. How about that? So expectations, well, hold on. Let's go with the day count. 2 days down, transitions into the first up day. This is on the S&P. Again, as I said, we're 5 days off the bottom on mid caps and small caps. SPX in the range. This is the slowest range, closest we've been to the 21E in over 2 weeks. Negative expectations coming in after the close of the lows last week, but definitely positive action off the lows. My expectations certainly won't be as negative tomorrow as they were today. On support and resistance on the S&P, we undercut this 35.88, but reclaimed it with our close today. And then above the support and resistance level, this 36 to 36.47, which were the prior two shakeout lows when the market tried to make a bottom. So also some positives there. As far as the NASDAQ 100, above this 269, 272 level, we got into 275 and pulled back there into the close. So some more checks in the plus column. 11 out of 11 sectors up today. I mentioned bonds were weak. Let's look at the TLT very quickly. This is the 30-year bond. Inverse to price, or its price, the yield is inverse to the price. So you can see it had its shakeout here on 9/27. So arguably that's kind of an island low on the TLT. If you take a look at the 30-year, the 0TYX, you'll see that that was the peak of rates also on the 30-year, and we've been pulling back since then. Also on the 10-year, the TNX, same thing. Here's this spike high on the 27th and 4 days down now, actually bounced at the 21-day today. So that's what bonds are doing. Let's look at the dollar. Dollar pulled back. I mentioned again today it was up higher. It also peaked late last week. Now, notice last week stocks kept going down while we were getting positive action out of the dollar and out of bonds. That tells me that people still wanted to sell stocks regardless of what was going on with the dollar and bonds, and then they stopped today almost like they sold everything that they had to sell and then had the big bounce today. So that's the way I see it. More positive signs again with bonds and the dollar doing what we want for if you're bullish on the stock market. Oils, I mentioned because of OPEC, had a huge day today. 11 out of 11 sectors up. Coal was strong, XME strong, gold and silver stocks were strong. In fact, silver was up over 8% today with a big gap up. Now, this thing is prone to making exaggerated moves that fail, but we certainly will keep an eye on this because, as I pointed out to the fellas late last week, gold and silver stocks have been showing relative strength. And over the weekend, after I did what was left of the 21-21, I added a couple on, and we're going to go through that list here momentarily. A lot to cover today, as it's possibly a pivotal day back to the upside. I say possibly, there are no absolutes in the market. focus coming in was on the remaining leaders, and we did buy 3 of them, and then shorting the indexes into the resistance. But that undercut, we haven't gotten really into resistance yet. By resistance, I mean the 21 as a place to put a short on. Let's see what happens at the 8 tomorrow, as that's where we paused today. But with the undercut, the risk reward was there to go long. We bought in lower on the UPRO, which is basically a 3 times long of the S&P. We bought in longer than where we took our profits on the reversal, small profits on the reversal last week. So we've got that going for us, which is nice. Gunga la gunga. I wonder how many people will get that reference. Text me or email me if you do. So, and then we bought today. We started, the first stock we bought was CEG, certainly one of the survivors. Move up. Note the stochastic hook-off oversold. Was acting well early, back above the 21 on a nice move. Look at the lovely relative strength line. They don't get better than that. Second stock, then we bought UPRO. Second stock we bought was First Solar, one I've been watching for a while. Nice tight base here, very clear stop. Shouldn't break below the lows of last week, which correspond to the 21-day exponential moving average. And then finally we bought Lithium. Livent, I should say, LTHM is the ticker. So this had a huge, a big downgrade and had a big gap down. In fact, it opened up down 3%, got to down 6%, and that just shook everybody out. Look at the volume here on the selling. This got rid of everybody that it wanted to sell, and then it just started going higher all day long except for into the close. After it cleared this area, I got very interested because you can see on the daily chart how clear 30. It's very obvious that 30 over here, here, and here. 30 has been support over the last month for this. So it undercut, reclaimed 30, back above the 50-day moving average. All good stuff. A big shakeout below and reclaim of the 50. Notice the volume higher. This is everybody selling early in the day. Yes, I know the volume patterns aren't ideal, but as far as there aren't that many stocks holding up, we're near oversold here. The stochastic should hook up if we continue to have some good action, but the risk reward with a stop below 30 and or the 50-day moving average, which is right on 30, too good to pass up. Love the shakeouts and reclaims of support. So those are the 3 stocks that we bought and why we bought them. This brought our volatility adjusted beta to 0.28, so 28% of what the S&P 500 is. With these 4 positions that we have, the first 3 are profitable. Lithium, we're down less than 1% on it as it faded into the close. But no re-entry back into the market is risk-free, but I feel good about where we got back in and the progress that our buys made during the day after we bought them. So to bottom line it, big bounce to begin Q4. Watch the small and the mid caps. They outperformed last week. You know, the follow through day thing, I don't know, but it is day 4 and day 5, or day 5 off the low for them as opposed to just being day 1 for the big cap indexes. And so we take another shot at the market. We're up about 0.1%. I think we're up 0.1% today, as you can see here on the GROTECTION return. When we take a dip into the market, we don't want to lose more than 1% initially. That's the equivalent of taking 5 2% stock positions and each one getting stopped out at 0.2%. That way you only lose 1% on your portfolio. We've re-entered 11 times this week or this year, gone to cash and re-entered, and haven't come anywhere near that drawdown any of the times that we re-entered. Most of them have been very small losses. We make a little bit of progress. They pull back, we sell, and the market continues its trend lower. But I'm pretty happy with this reentry. I like the action. There's more reason to be optimistic than there was if it was just one day off the bottom on all 5 of the indexes. Of course, I could be totally wrong tomorrow, in which case our stops will take us out, and we'll be right back to where we started this morning. So here are the support levels we reclaimed. 2 big support areas here. This was another reason why I didn't hesitate to take the position, particularly in UPRO. This was a big area of support. This 35.75 to 36.14, we closed inside this range today. Additionally, this 35.50 to 35.88, that's going all the way back to the November 2020 breakout. Let me bring up the S&P 500 here, and you can see here's the 35.88. We attempted to go higher before a correction in late September, and then we broke out again in November of 2020 above this 35.88 level. So this was a base that formed after the big COVID run. Where did we pull back yesterday? Or sorry, Friday. Excuse me, Friday's low 35.84. We undercut that. Excuse me. So the close undercut, we undercut further overnight with the futures as they were down in early evening yesterday, and reclaimed all that by the opening today with the gap up that we had. So plenty of reason for optimism, more than just a typical day one up, is how I'm bottom lining this today. So we took a shot. We've got a couple more stocks that we're taking a look at. In fact, let's bring up everything I have in what I'm calling my 21 over 21 list. Let's sort it by how they did today. Now, the way I do this is anything that is of interest during the week I throw into this list, and then I call it down to whatever deserves to be in there by the end of Friday when I redo the 21 over 21 list. So you can see that silver gap up, that's big. It's got volume. You can see 3 big volume spikes, in fact, on silver, and the relative strength has been there also. PXC, this is the best acting. When I saw the oil stocks gapping up this morning, I looked at the ETFs. This was by far the best acting of the ETFs. This gapped, it held the 200 better than any of the others, and it gapped above the 21 and got above the 50-day moving average today. Notice the stochastic is only a week off the low. So PXC, if I want to go into oil, that's at near the top of my list, although there are some stocks that are looking good too. BTU, coal stocks acting well, very similar to the oil stocks and gold stocks. Maybe anything that you drop on your foot that will hurt your foot is where the money should be. That remains to be seen. CEG, we bought this today with the move back above the 21, great relative strength. GDX, here's your gold stocks. I saw they were gapping up pre-market, and note the big blue volume bars late last week. Closed above the 21 last week, got above the 50-day moving average today. Dyno, this is a oil stock that made an all-time high and also with relative strength. It's a refiner. First Solar was on the list. We bought this today. Vertex on the list, didn't buy it, but relative strength is at a new high. This probably would have been my number 4 buy today if I had bought a 4 stock. GOLD, again, here's an individual stock. It's tough to buy the stocks, because the gold stocks, but when they make a group move, you're almost better off going into the indexes because it's hard to pick which one outperforms. Trust me, I've looked at a lot of gold stock bull runs, and the leading stock varies all the time. Right now, GOLD, I would say, is sticking its nose out first. It's the best combination of liquidity and relative strength, and you can see it closed above the 50-day moving average today, but doesn't look that much better than GDX. And then you can buy NUGT if you want to do 2 times leverage. LNG above the 21, NBIX, biotechs actually lagged today, but this is one of the best looking charts. Relative strength at a new high last week. Shockwave, not a good close today relative to the rest of the things that are in this list, but it did have a nice run after this sellout a week and a half ago. Lithium, we bought this today with the shakeout below the 50-day moving average and back above support. SRPT, nice long flat base being formed there. And HLIT, the thin stock that I am savoring over for some reason. They've got a really good story and fantastic volume and relative strength. So those are the stocks that I wanted to review as part of what's going on today. Some select leaders really acted well. So you've got leadership along with good action in the indexes, and now we'll see how far this rally could go. As I said, I think it's a little better than a typical day one rally. We took 4 positions. Our stops are in place. The damage will be minimal if we get stopped out, and we'll see what tomorrow brings. So that's it. As always, love to hear from you. Email don@revereasset.com. The phone is 855-REAL-WEALTH. That's 855-732-5932. So wrapping up, Monday, the first day of Q4, wrapping up Monday, October 3rd. This is Don Vandenbord telling it like it is. Remember, it's not how much you make in the markets, it's how much of that you can keep. Thanks for listening and have a great day.